I want to start with this recent announcement about a $10 billion equity investment that JPMorgan is going to be making in critical areas in the U.S. in terms of companies. What does this entail in terms of building out staff, building out capabilities beyond what you already have?
Well, first off, it's great to be here. Thank you very much. The strategy has two prongs, and we're really excited about it. One prong is capital investment on our part, arguably equity into different ventures of up to $10 billion. And the second piece is $1.5 trillion of financing. Now, to be fair, we were arguably going to probably do close to $1 trillion on our own naturally, but this really gives us a chance to double down on critical industries for American security and for our allies as well. In terms of staffing, the capital investment, we're going to hire a new team to do that. They're going to be professional investors. They're going to make decisions independently on their own. We'll have an advisory board. And again, we're really excited about it, but that's going to be a new group which we hire for. In terms of the financing piece of it, is we have a lot of infrastructure already in place, but we think we're going to need to hire some more people to help us expand the effort from roughly $1 trillion to $1.5 trillion.
How much is that new group directly in competition in some ways with some of the private asset managers that have been investing heavily in infrastructure, particularly in this space?
Sure, we just don't view it as competitive. And look, I know people love that narrative. They love talking about how banks and non-banks are fighting with each other. But we have a really, really long-term track record of engaging clients and managing the conflict when they are competing with us and when they're a customer. And the vast majority of the time, they're a customer. So, while there'll be specific deals, probably outside this space more often in things like private credit, where we really compete with each other, the vast majority of it will be an opportunity to partner. And I'm not worried about it at all.
So partnering with private asset managers, how much are you also expecting to partner quite a bit with the government? We're in Washington, D.C., and they're doing the same thing, evidently.
We're doing this on their own. This is a JPMorgan initiative. It's entirely on our own. But we're realistic. There's going to be opportunity to partner with other people, asset managers, as co-investors. And there's the probability that we end up in a partnership or in the same investment with the government. And that's okay, too.
Yeah. Well, in the meantime, you just reported earnings, and they were pretty incredible. All of the banks really came out with pretty tremendous results. The profitability in the banking sector in particular, pretty blockbuster. I'm just wondering how big the pipeline is to continue this type of activity in M&A and deals and debt issuance.
Sure. I mean, I've honestly never seen a summer like we've had or a Q3 that we've had. It's just incredibly rare that you have every line of business achieving such incredible results that you mentioned we reported yesterday. I mean, security services, payments, investment banking, markets. Normally, if markets is busy, nothing else is, because it means something happened bad in the middle of August. And if banking is busy, markets tends to be slower. So it's a pretty incredible moment. Obviously, as you said, it's flowing through into earnings. It's hard to tell how much longer it's going to last. It won't last forever. But the banking pipeline is very robust, and we would expect that to continue through Q4 and hopefully into next year.
What's spurring that? Is it really more certainty on some sort of geopolitical standpoint? Is it because the expectation of Fed rate cuts is percolating into markets?
I think it's a little bit of everything. I mean, I would say corporate confidence is really high. The trend of the Fed is definitely helpful, but I don't think that's the primary driver. Tax policy is known. So I think some of the really big uncertainties earlier in the year are out of the way. Some still exist. And I think there's an opportunity for people to really lean in and make strategic transactions that they want to get done now. And there's been a little bit of a pipeline buildup that we're experiencing the benefit of today.
You were talking about the narrative that people in the media like to spur about private credit and private asset managers versus the big banks. And of course, that was kind of bolstered with some of Jamie Dimon's recent comments about cockroaches. You only see one, and maybe you see that there are probably others as well. And he was talking about some of the recent issues in credit markets. How concerned are you about some sort of systemic risk that is beyond the banking system that is really focused on credit?
Sure. I mean, I'm a trader by background. I worry about everything. And Jamie, I think when he refers to cockroaches, I mean, he can speak for himself, but he's really trying to keep us and everyone else on their toes. And you're starting to see things that feel late cycle. And I would feel quite strongly that we're in the latter innings of a credit cycle. The problem when being in the latter innings, you don't know if you're in the 6th inning or the 9th inning, and no one will ever know until afterwards. So Equity valuations are very high. Credit spreads are very tight. You're starting to see things that Jamie was referring to. I mean, whether it's fraud or whatever it ends up being, but significant cracks in certain businesses and business models all make you nervous. So while it could last certainly for another 6 or 12 months, we're just being a lot more cautious in how we think about credit.
What does that mean? I know that there were bigger loan loss provisions that were set aside, but is it also in terms of tightening lending standards as well?
I mean, we've always been very disciplined at JPMorgan. We always evaluate every deal on a standalone basis. And we're just making sure that we're sticking to what is our core credit philosophy, like being very disciplined on the quality of the credit, the terms, the pricing. And I think as long as we continue to do that, we can be comfortable. We would hopefully avoid any very large missteps.
What's the mood like here in Washington, D.C. at all of these meetings? I mean, do people have a great deal of optimism because of what we're seeing in markets?
I think it depends on who you ask. I think in many ways, people are just confused. There's so many cross currents happening in the market at the same time, from geopolitics, global macroeconomics, markets. They're much more volatile than they were before. I think 3 themes really stand out to me that I get asked in virtually every meeting is the state of the U.S. economy, what's going to happen, is the Fed going to keep cutting, all sort of bundled around how the U.S. is doing. The second is U.S.-China relations. Trade is back front and center, particularly tariffs, and I think it had been on the back burner, and now it's back. And then the last thing, because it's the IMF and there's a lot of emerging market clients and regulators here, is the value of the dollar, particularly against the yen, is a big focus.
So we can dig into each of those. The first one, what do you see as the bigger risk? The idea of some sort of reacceleration in inflation or some sort of more significant deceleration in growth?
I mean, I would say the biggest risk is both. Deceleration in growth with inflation staying sticky or potentially going higher. I mean, there's some inflationary currents in the system, fiscal stimulus, et cetera. So, you could get a continued slowdown in employment while inflation stays sticky. And I think that's the most significant risk in my mind.
Do you see signs of that?
I mean, the labor market is definitely slowing. Growth seems to be holding up, but if the labor market continues to slow, that's going to be a crack for the consumer, and you potentially see changes in consumer behavior. And I don't see anything that's going to significantly drive down inflation. If anything, it will stay where it is, or in my opinion, tick up slightly.
The other issue is the geopolitics of the moment, and you're a global bank. I'm just wondering, from a global footprint standpoint, how much your life has changed over the past 6 to 12 months in terms of where you're expanding, how you're doing business as a U.S. bank, the biggest U.S. bank with a very international footprint.
Look, international has always been extremely important to us, particularly in the CIB. And we see tons of opportunity around the globe. I mean, I would say in terms of standouts, it would be the Middle East and Asia, particularly Japan, Australia, Southeast Asia. But there's really opportunity for us to grow everywhere, and we're really focused on it. I think historically, as a big U.S. bank, we've really benefited from the size and scale of our footprint in the U.S. And we're obviously in the center of both inbound and outbound investment out of the U.S. But we're focusing really hard on trying to build those non-U.S. corridors, Middle East to Europe, Middle East to Asia, Asia to Latin America. If I think about our future, getting that right, and we're already good in those places, but really getting it right is super important for us.
Is it awkward to have a presence in China at the same time that you're investing in strategically important companies in the U.S.?
No, not in my opinion. I mean, we're a global bank, and there are plenty of our customers, certainly even U.S. customers of significance, they're doing business in China. Our job is to be there for them. So we're going to continue to do that. I mean, we're investing in the very long term everywhere, China included. Obviously, we're cautious. Obviously, we pay attention to geopolitics and the economics on the ground. But, while there could be a worst case scenario, more than likely there's a path where we continue to be a partner with China. It might be very different than the past, but I'm comfortable we're doing it thoughtfully, and we're going to continue doing what we're doing now.
When it comes to the de-dollarization, do you actually see clients moving away from the dollar? Or is this sort of something that people are hedging against and then going into dollar-denominated assets as quickly as they possibly can to get some sort of exposure to artificial intelligence?
Look, I think there's 2 themes when people say de-dollarization. One is, what are they doing in the moment today with their U.S. assets? And we've seen very little evidence of people selling US assets. What we've seen is people hedging their US assets. So I think before people had much lower hedge ratios. So if someone had a 50% hedge ratio, they're kind of going to 65 or 70. That's what we're seeing. We're not seeing them sell the underlying assets. The other part that people talk about is like, is the dollar safe as the world's reserve currency? And I think it is. I mean, obviously you can never predict forever, but and I don't see that changing anytime soon.
The AI story is something that your team has talked about and you're investing significantly in. And I was so excited to look at the headcount of JPMorgan after these earnings. And I was looking, okay, has it gone down dramatically as you invest in AI and all the AI and the chatbots take over humans, and actually expanded? It actually went up in terms of the headcount. How do you explain that in terms of the efficiencies? Is it working in terms of creating value?
So I definitely think it's working, but it's still early stages. And we're simultaneously investing in it and reaping some benefits. But I think the really big benefits will come in the future. And you have to keep in mind, we're really growing. We're covering more clients. We're moving to more geographies. We're going to more cities in the US. It all requires people. So, what we see in 2 years or 5 years could be very different. But for now, I don't think it's contradictory that we're investing in AI, getting the benefit, and our headcount went up a little bit.
Do you expect that to continue in terms of the investment not necessarily reaping benefits over the next, say, year, 2 years, or do you think it's going to be a more imminent type of transition?
I think it really depends on the part you're deploying AI. I think we're already seeing the benefits in specific areas of some significance. Fraud detection, operational efficiency, those things are very impactful already. And there'll be spots where you'll see headcount change, I think, in the near future. And you're going to see other spots where you don't see headcount change at all because we use AI just to do a lot more. But I think this will play out over the next 2 to 5 years, not necessarily the next 3 to 6 months.